Hello, Smarties, and welcome to Thrive in 25, our webinar number 2. Today, we're going to be doing an in-depth review of Pier for Reit. We're going to be chatting with Darren Gazdag, who is the VP of Sales, who's going to be talking about their fund and why investors should be paying attention to it. But before we get started, I just wanted to take a quick moment and outline what we're going to be doing today. We're going to be giving you an introduction to Westcliff. We're going to be introducing Darren Gazdag and Pier 4 to you. We're going to be going over an investor presentation. We have taken a couple of slides out of their investor presentation, and we have prepared a whole bunch of questions for them to help investors understand why they should be paying attention to this REIT. And we're going to be talking about some next steps and disclaimers. My name is Adi Saeed. I am a dealing rep licensed with Waverly Corporate Finance with a background of being a realtor and an investor over 18 years. My partner in crime here is Gazdag, who's also a dealing rep with the same credentials. And he has a background as a CPA, CA, and real estate finance expertise spanning over 2 decades. So our ethos or character at Westcliff is learn, invest, and manage. We teach and empower our investors and subscribers through education, clear and comprehensive information, and simplify complex concepts through our podcast, which is made public on a weekly basis, as well as webinars like these, which are done on a monthly basis. Once you have accumulated enough knowledge, we also help you invest any funds that you have into well-researched real estate equity and debt facilities. And we help you maximize your value while maintaining transparency and integrity. If you're interested in joining our Westcliff Investor Network, you can go to win.westcliffam.com. Or if you're interested in joining us and having a conversation one-on-one, you can go to cal.westcliffam.com. And on the managed side, we also help clients with their active real estate investments. If they're looking for third-party help to manage any investments that you have, feel free to reach out. You can find more information at westcliffam.com. With that, I'd like to welcome Darren. Darren, thanks for taking the time and joining us. Before we get started, do you want to give us a bit of a background as to how you got to Pier 4, how you got started in money raising, and what Pier 4 stands for?
Yeah, well, thank you. I really appreciate the opportunity and certainly good afternoon. I've been in the financial services industry for 20 plus years, sort of fell into it accidentally, if you will. Needed a summer job, and fortunately, we had a family friend who worked at Dynamic Mutual Funds a long, long time ago. And as a summer student, I had various roles. One was in operations, other was working with a marketing controller and doing some client services work. And then after school, I was fortunate to be offered a sales associate role with a branch manager. So Dynamic took their original charter Dynamic Investors and started a company called the Private Investors Group. And as a result, now all these dynamic investors had access to all of the other 6, 7, 8,000 mutual funds that were certainly available. And that was wonderful. And then I got this great opportunity to move south of the border to work for a telecommunications company in Miami, Florida. I was there for 4.5 years, came back and got sort of re-engaged, if you will, in capital raise and financial services. And I was with SCI, they're a wrap fund provider based out of Oaks, Pennsylvania. I joined their Canadian operations, and they'd been up and running at the time of when I joined for approximately 10 years. And then moved on to XL Funds for about 10 and a half years, mutual fund provider exclusively focused on emerging market opportunities. And they were acquired by Sun Life Global Investments. So I spent a little time there for 2.5 years, and then moved on to the private side. Got my sort of foray, cut my teeth, if you will, at Equiton. And I have, or will have been at Pier for 1 year, end of February, end of this month. So time does fly. And I must say, it's been an incredible journey. I've had the opportunity to meet some really, really wonderful people. And fortunately, I've certainly learned a lot, for better or worse.
What did you enjoy the most about your journey so far?
Really just a chance to work with a whole different type of people. Some really smart people, MBAs, various backgrounds, and really learn how working with the broker-dealer community, how to prudently allocate assets. And I just found that really, really interesting. I mean, there's just so much to sort of digest and make sense of, to understand models and how they work and all of the intricacies and how the global environment really plays into a lot of decision making really just fascinates me. And along the way, I've been fortunate to represent some really strong companies with great solution sets, I feel that I've been able to sort of help advisors and investors hopefully get from A to B and sort of mitigate some of those unfortunate speed bumps that the markets could certainly bring to bear.
Well, that's great. So tell us more about PR4 then.
Yeah, so I think really what differentiates us is that we are really focused on acquiring value add buildings with really strong potential for improvement. We really are focused on identifying overlooked properties and enhancing their value through renovations and strategic upgrades. We certainly feel that this approach not only boosts the property's value, but also really elevates the living experience for residents. So we target low to mid sized buildings in strategic, growing markets outside of major metropolitan areas. So, quote unquote, secondary markets, investing in opportunities that we feel are certainly overlooked by many others. And our strategy really allows us to purchase assets with less competition. So, our ideal property is a walk up building, generally speaking, no elevators, no underground parking. And why? Simply to minimize maintenance costs. So, we typically invest in buildings that have 17 to 70 units with a high gap to market, that being the difference between in place rents and market rents. And our gap to market across our portfolio currently is 59%.
Okay. So you mentioned in your presentation 5.47 implied cap rate. Does that mean that's the cap rate you're going in at when you're purchasing these properties?
Well, that's generally across the entire portfolio. So it might vary from property to property. But just to share with investors, as per our presentation here, that's what can be assumed exists across our entire Pier 4 portfolio.
And that's part of, with 29 properties and 800 units so far and 97.48% occupancy.
Yeah, maybe just a caveat there. We actually have a couple of buildings currently under contract. Our last one should close March the 12th of this year. So we will be at 31 properties, 892 doors. So really strong growth, certainly over the last 4.5 years.
Yeah, I was noticing your growth pattern. It looked like you guys were pretty much doubling up since your inception in 2020. You guys have been doubling up and you're getting close to doubling up again this year. Am I right?
Yeah, we think actually 2025 is going to be a banner year, if you will, for a whole host of reasons. We now have a very solid track record. We've been able to form solid partnerships across various dealers. There's generally more interest. Certainly, with interest rates coming down, I think market sentiment certainly is picking up. And I think we do, without question, sort of occupy a very unique niche within the private REIT space. So we couldn't be more excited, and we just want an opportunity to tell our story and shout out loud, if you will.
You know, you touched on a very interesting point, your strategy and your niche that you're going after. Is there any specific experience that the management brings that makes like what does their track record contribute to Pier4 success?
Yeah, great question. I think first and foremost, it's important to understand that Pier 4 REITs is a family owned multifamily REIT that was established in Q2 2020. So, great time to start a business right during COVID, right? What else are you supposed to do? So, it's really built on 40 years of experience in the real estate industry, including ownership, property management, and capital improvements. So, prior to founding Pier 4, the Ashby family successfully operated a general contracting business since 1981, and they were serving really some of Canada's largest landlords and later evolved, if you will, into acquiring their own portfolio. And that was really in the early 2000s. And then, really, through the years of all of this experience of being owner operators, the family decided to innovate and create Pier 4 with the idea of allowing investors to invest alongside them. So today, Pier 4 operates from two offices, one in downtown Toronto. We have certainly over 40 employees. We're constantly hiring. In fact, last year we were recognized as one of Canada's fastest growing companies. So certainly something that we're very, very proud of. We offer full service asset and property management solutions. And as mentioned, the best is yet to come.
So I guess that's why you guys have internal property management because a lot of times, a lot of the smaller funds, it's a math calculation when you decide that you're going to become internal versus remaining external. Can you speak a little bit more about that?
Absolutely. We've certainly internalized all of that, and it's really for better control. Certainly allows us to execute our strategy very seamlessly. So that team is definitely growing, certainly across Ontario. Another key differentiator for us is that we're staking a significant footprint, if you will, across Atlantic Canada. So again, just by able to sort of control the process, we're able to certainly cut costs and just assure that everything is done properly, effectively, efficiently. And ultimately that benefits obviously the residents, but ultimately also to the investors. So we're always looking at ways to maximize investor return. And this is just one of the ways to do it.
I guess that's a perfect segue to talk about your investor growth since inception. What do you want to tell us about that?
I think really by every metric, it's strong. 40+% return for Class A, and certainly, $100,000 invested, certainly since inception, has grown quite handsomely. This number is as of September the 30th. Consistent, steady, predictable returns. Just to share with you, we have a targeted 8% distribution, a 12 to 15% targeted return. We're 100% return of capital, so extremely tax efficient. And again, I think that's just really attributed to, again, being a little bit different, targeting a different asset or building, and certainly zeroing in on the fact that most of our properties have significant gap to market. So certainly our runway is long, and that ultimately will help investors to maximize their respective returns. And last year was really great. We had a couple of NAV increases. We started 2024 at 1055. We then went to 1075, and today we're at 1090. So that's 35 cents. So far, so good.
Darren, with what you said, I was picking up on the 8% distribution yield. You're obviously acquisition mode where you're adding properties to the portfolio. You're spending money on capex to obviously renovate and drive up those rents. How do you guys look to sustain that 8% yield, and how does that come up? That seems a little bit higher than some of the other funds I might have seen. So.
I think it's just the type of buildings we buy. We generally buy off market, we buy below market for the most part. Even though we do work with a broker dealer community, we do go door knocking. I think certainly we've established ourselves as a niche player. So we certainly have a lot of owners reaching out to us. And again, we really do concentrate on those value add buildings with high gap to markets. Certainly, if you look at some of our recent acquisitions, in some cases, they've been 100%, with potentially 7 to 8 units that are empty. So that gives us an opportunity right from the get go to add value, to raise rents to market. And another thing I think that's really important, just in terms of the whole process and strategy, is that, when a unit is empty, we target to fully renovate it within 30 days. So we have a sort of a 3-tier renovation process, if you will: bronze, gold, platinum. Platinum might be something more fulsome like granite countertops, flooring, etc. But nevertheless, we're able to execute this. You make money on the buy in real estate, and fortunately, we've certainly been able to do that without question. And I think certainly, as mentioned, buying off market, really buying from mom and pop small partnerships who've owned some of these buildings for, in some cases, multiple decades. They're cash flowing, but they're not necessarily run effectively and efficiently. So professional property managers with a proven track record, we can quote unquote unlock that intrinsic value. And fortunately, since inception, we've paid a very handsome distribution of 8% compounded annually, paid out monthly.
And talk a bit about redemption. So if investors want to come in and maybe for whatever reason they need to redeem, how does that process work? And then have you had significant redemptions in your history?
I guess first and foremost, the fund has never been gated. I think that's obviously very, very important. Liquidity certainly can be a cause for concern. In our case, we're certainly advocating that privates don't necessarily have to be 100% of anything, but they certainly should be a representative in your portfolio. And as you guys are well aware, the smart money, all of that institutional big player money, has been advocating and allocating to private REITs, privates in general, for a whole host of years. So in terms of our Class A, which is available on Waverly Shelf, our redemption schedule is first year 92%, year two 94%, year 3, 96%, thereafter 100%. So redemptions are paid on a quarterly basis, 60 days after the end of the last quarter. And then we also have LP units, so flow through. So very similar, other than 3 years, the redemption schedule is 5 years, so free and clear in year 6.
Right. And just last question on this slide, just building upon what Adi was asking, you're seeing this $100,000 example here where it's grown significantly since inception, since 2020. Talk a little bit about, when you look at your NAV, your valuation policy and things that you're doing to ensure. One of the common things that people are concerned about with private deals is that they're not always mark to market in terms of the valuation. So kind of what are you guys' policy and how do you ensure that the investor value is going to reflect what's realizable?
Yeah, so we have annual appraisals done by third parties. And then we also have quarterly desktop analysis or appraisals done as well. So we're certainly very confident that from a transparency standpoint, investors should feel very secure in terms of buying a sound and very well-run portfolio with all of these sort of overlays, just in terms of ensuring due diligence is in fact done from top to bottom.
Well, since we're talking about strategy, can we go back and talk about your triple R strategy that you guys had? Can you tell us a little bit more about it?
Yeah, absolutely. This is something, again, that as a company, we're extremely committed to. We're really focused on trying to provide investors with a well-managed, diversified pool of multifamily assets. As mentioned, we're really focused on acquiring value-add real estate assets really across Canada and optimizing profitability really across the entire portfolio. And again, with a real emphasis, if you will, on maximizing investor returns. So we look to create value to the portfolio really from the beginning. This triple R approach, one, realize. We want to look for properties with very strong return potentials, avoid market competition with off-market acquisitions. 2, revitalize. Obviously, we want to increase revenue streams, but we also want to reduce expenses. And then obviously from a return, so a targeted 8% distribution, a 12 to 15% targeted return, special distributions, etc., sort of takes us to where we are in terms of rounding out the triple R approach, if you will.
So a couple of questions. First of all, your average historical renovation cost is around 11,000. Is this since inception? That's
Yeah,
what you're talking?
we're in the midst of just sort of updating some of the data. So the number has just gone up a little bit. It's actually 12,500 since inception. So again, that really comes back to the beginning and the Ashby family running a very successful renovation company since 1981. They have very deep and long-standing relationships, and as a result, we buy in bulk. I'm certainly not suggesting that walking into our warehouse is similar to a Home Depot, but we do have skids of countertops, kitchen cabinets, toilets, etc. And then, as I alluded to, we have that 3-tier institutional approach. And because we do the renovations internally, again, we're able to effectively control the costs, time frame, i.e., we target a 30-day turnaround time. So we're quite proud of that number. And again, who benefits? The investor.
That's a great story. How do you guys balance capital appreciation and making sure your distributions are paid when you have renovations going on as well in your portfolio?
Yeah, well, certainly the asset management team meets on a weekly basis to really oversee cash flows from a property perspective. And certainly during market downturns, Pier 4 has strategically acquired properties with strong market gap, certainly positioning them really for long-term value. And suffice it to say, the last couple of years have been quite challenging, obviously, with interest rates, but we were able to grow. And I think a lot of that can be attributed to certainly how we go about buying properties. But again, I just want to reiterate, since it's on the slide right here, is we are targeting buildings with high gap to market. So we have a lot of flexibility and certainly great potential just in terms of sustaining growth.
So can you just run me through what's your ideal acquisition property?
Yeah, so in secondary markets, we're expanding our footprint in Ontario, Kitchener, Guelph, London, etc. And then obviously in Atlantic Canada, Moncton, Halifax, etc. So again, we are looking at buildings that are generally 3-4 story walk-ups, no elevators, no underground parking to minimize renovation costs. Buildings are generally 17 to 70 units. These are value add properties. And then we go in and overlay our management approach to really unlock that intrinsic value and take advantage of that high gap to market and bring rents up to market. And in doing so, present and offer up a nice, enjoyable living experience, certainly for our tenants.
Well, this is a great segue to talk a little bit more about your recent acquisitions. Can you tell us why did you guys decide to go into Halifax, Nova Scotia? Well, because you guys are mostly focused based on in Ontario, and I think if I recall correctly, you guys were focused a lot in the KWC area before you started stepping out. Why Nova Scotia?
Well, I guess first and foremost, there's great opportunity. I mean, certainly if you look at the last 4 or 5 years, some of the fastest growing cities, certainly across Canada, have been in Atlantic Canada. But I think even more importantly, big picture is regardless of the where, we are really focused on looking at current economic indicators. So population growth, immigration rates, rental rates, vacancy rates, if you will. We also want to see where governments and consumers are spending money. So in Moncton, there's a huge Walmart distribution center. Government is without question investing money there. Infrastructure is obviously very, very important within the city. We want to see that connectivity, if you will. Those are just some of the reasons. And then certainly if you look at some of the headlines over the last couple of years, the Monktons, Atlantic Canada really as a whole is just growing exponentially. And then certainly from an owner perspective, which I don't think can be really ignored, there's favorable landlord regulations. So there's no rent controls in Moncton. There's a 5% allowable increase in Halifax each year on rent. So certainly that is a consideration. But first and foremost, we follow trends and we want to invest and buy where people want to ultimately live. And there's tremendous opportunity, and we continue to be really focused and committed to expanding our footprint in Atlantic Canada. I hope that answers the question for you.
It does. What are your thoughts on because Nova Scotia has been talking about implementing a rent control legislation. What are your thoughts around that?
Well, I guess until they do, we'll deal with it then. But again, I come back to a significant competitive advantage we have, and it's that gap to market of 59% across our entire portfolio. Some of the recent acquisitions, certainly in Atlantic Canada, they've been 100%. So we feel that we are certainly well positioned, regardless of what might sort of come down the pipe.
I was just thinking about some of the acquisitions. I mean, one thing comes to mind is the level of, you mentioned a few times now, the gap to market. So obviously you're identifying opportunities there. But in terms of your due diligence, what are some of the procedures you're doing? How are you ensuring that you're bringing quality assets into the portfolio?
We have a team. So the investment process, if you will, which I guess is ultimately what you're sort of getting at, we really do source deals through multiple channels. I had mentioned we do work with brokers. We certainly work very significantly with owners. So once we sort of identified a property, we do an initial property tour. The team reviews the pipeline on a weekly basis. We have underwriting models that our analysts do. So that would encompass cap rate analysis, 10-year cash flow projections with CAPEX plans, market comparable analysis, which would encompass or include rent sales, sensitivity analysis, so market rent, interest rate, turnover, etc. And then that sort of just leads us into the whole acquisition process. So detailed legal review, debt sourcing, third-party reports, appraisals, BCE, due diligence, closing transition procedures, etc. So we don't just arbitrarily point a finger and say, well, that looks pretty, let's buy it. There's extensive research analysis that certainly goes in, and it has to make sense. People want to live there, needs to have be by schools, stores, etc. There's just a whole host of a long checklist, if you will, that needs to be monitored, reviewed to ensure that it's a proper property to include in the Pier 4 portfolio.
That's helpful. Like in terms of boots on the ground and being a bit hands-on, do you walk all the units? How do you ensure, for example, things like environmental risks or things like that? Because some of these properties being a bit older, requiring a little bit of TLC, there may be some exposure there.
Yeah, absolutely. We get all of those analysis done. We outsource third party. They certainly do through due diligence in terms of ground analysis. We walk all of the units. We know before buying a property what exactly will be required from roof to basement. So, certainly, that goes into the analysis of whether or not we're going to move forward. And if so, that may sort of impact in some way, shape, or form what we might bring or offer to the respective owner. So again, this is not something that this is done haphazardly. There's a lot of work, very detailed sort of spreadsheets that are adhered to. And then even after we acquire the properties, the team certainly visits it on a monthly basis. Our local teams are there on a weekly basis. So we're really on top of everything from top to bottom. No surprises. And again, we owe that to our investors.
Thank you very much, Darren. Really appreciate you taking the time and going over this. Sorry for putting you in the hot seat a couple of times there, but you did really, really well. Appreciate the answers that you have provided. So, anybody that is looking for an investment vehicle focused on real estate, looking at secondary markets with attractive returns, I might add, 12 to 15% is actually pretty attractive compared to the big guys and what they're doing. And exposure to multifamily, it definitely should be checking out Pier 4. For anybody else that is interested in learning more, please feel free to book a call with us. You can reach out to us via our website, cal.westcliffam.com, and you can see Kaz in my calendar over there and book an appointment with us at any time. Listen to our podcast. You can go to westcliffam.com/listen. You can join our online community, win.westcliffam.com. Do follow us on social media. If you have any questions, feel free to reach out to us, 647-799-2264. Email info@westcliffam.com. Anybody that is looking for a copy of these slides, you can send a text message with the word slides to 647-799-2264, and you'll be able to get a copy of these slides emailed directly to you. You will have to provide your first and last name and email address. As for everybody should understand that this webinar is for informational and educational purposes only. While we are professionals, the information provided may not apply to your unique situations. Please make sure to consult with the professional before making any investment decisions. And the rest is the disclaimer that is provided by Pier 4. Darren, thank you very much for taking the time to jump on this. I really appreciate you. Kaz, as always, my partner in crime over here. We look forward to having you guys again on the next one. Thank you very much for joining us. Take care, and we'll talk soon.
Thank you.